Royalty stocks can often fly under the radar, but there are some great ones you may want to keep your eyes on. Hold on to your seatbelts, folks. This is going to be a good one. Royalty stocks offer a unique and intriguing investment vehicle when it comes to building up your portfolio. In a nutshell, they are companies that own the rights to receive a portion of revenue or profits from, well, other companies or even resources. You do see this a lot in mining, energy, and franchising of fast food. Unlike traditional stocks, royalty stocks provide income directly linked to the performance of the companies they hold royalties over. This structure allows investors to benefit from the revenue generated without the operational risks and, of course, the capital expenses associated with running the underlying business or project. Investing in royalty stocks can be a smart addition to a diversified portfolio, primarily because of their potential for providing stable, long-term income streams. These stocks are often less volatile than conventional equities, since their earnings are not directly tied to the stock market's fluctuations, but rather to the performance of the specific asset. This can make them particularly appealing during periods of economic uncertainty or market instability. Also, royalty stocks often operate in industries with higher barriers to entry, such as mining or energy, which can lead to less competition and more predictable revenue. Additionally, they do offer a little bit of a hedge against inflation, as royalties from resources like minerals or oil typically increase in value when prices rise, making them a strategic choice for your diversification plans. In today's video, in addition to the 5 royalty stocks, I do have a bonus stock for you today in the flavor of uranium. I never actually want to find out what uranium tastes like. Join the conversation. Let us know in the comments if you hold any royalty stocks. Your participation is, of course, well appreciated. Don't forget to like and subscribe to stay up to date on future content. And a huge thank you for that click. With today's list, we have found 5 royalty stocks and that bonus stock that all have a positive year-to-date return. And speaking of that return, that is also how we will be sorting them. Most of these stocks have outperformed the TSX this year, except one, which I included for their history of absolutely crushing it. Anyway, without any further ado, let's do this. Kicking off this list, we have Sir Royalty Income Fund with a ticker of SRV.UN. They hold many popular food franchise royalties, including Jack Astor's, many tavern chains, and the Loose Moose. I just wanted to say Loose Moose. This is a royalty that we do currently hold in the 0 to 100K TFSA challenge. Their current price comes in at $16.40. They have a market cap of $137.36 million, and their beta more than twice as volatile as the market average, coming in at 2.56. Earnings per share come in at 1.78, and they have a price to earnings ratio of 9.21. Their return on equity, not bad, 21.09%. And as for debt to equity ratio, forget it. They got no debt. When we look at their returns, they have a nice looking dividend yield, 6.951%. It is a monthly dividend paid out in the amount of 9.5 cents per share. Their payout ratio comes in at 64.04%, so it is very sustainable. When we look at their return on investment for the 3-year, that comes in at 386.65%. Factor in the dividends, we get a 473.44%. Holy banana bread, that's the one that's crushing it. Looking at their year-to-date ROI, that does come in a little bit low at negative 6.55%. Factor in the dividends, we get a total return of 0.23%. Keep in mind, the TSX year-to-date, 5.51%. So this is the one that did miss the TSX, but let me tell you, they have had an amazing 3-year run. Coming in at number 4, we have a community favorite with Pizza Royalty Corporation, who have a ticker of PZA. They are a huge pizza chain under the names of Pizza and Pizza 73. Their current price, it comes in at $14.34. They have a market cap of $463.72 million. Their beta, very average at 0.99. Their earnings per share come in at 0.95, and they have a price to earnings ratio of 15.09. Their return on equity, that comes in at 10.36%, and their debt to equity ratio, not bad, 15.94%. They also have a nice looking yield of 6.485%, and that is a monthly dividend of 7.7 cents per share. Their payout ratio coming in a little on the high side, 91.05%. When we look at their return on investment for the 3-year, we come in at 55.19%. Factor in the dividends, we still come up to 75.75%. Not bad. In 2023, year to date, their return on investment comes in at 5.29%. Factoring in the dividends, we do get 11.25%. It's just a little more than doubled what the TSX did at that 5.51%. Not too shabby. Even if we were to enter a recession, pizza is just one of those guilty pleasures that people are still going to want to have. And that bodes well for this royalty stock. Taking our third spot, we have more pizza. Yay! With Boston Pizza and a ticker of BPF.UN. It goes without saying that Boston Pizza is another of the huge pizza brands in Canada, even though they are much more than just pizza. They have a current price of $15.79. Their market cap, that comes in at $335.99 million. Their beta, that comes in at 1.64, and their earnings per share come in at 1.37. Their price to earnings ratio, that comes in at 11.53, and they have a return on equity of 10.84%. Their debt to equity ratio, a little bit higher at 43.62%, but it's still pretty good. Nothing really to write home and worry about. Their yield, one of the higher on the list today, comes in at 8.132%. That's a monthly dividend of 10.7 cents per share. Their payout ratio, 91.24%. When we look at their returns on the 3-year, their return on investment comes in at 58.53%. Factor in the dividends, we get a total return of 86.72%. This year in 2023, their return on investment, that comes in at 5.20%. Factor in the dividends, we get 12.26%. Once again, we've doubled the TSX's year-to-date of 5.51. So far, food is dominating this list, but let me tell you, that is about to change. In our almost top spot at number 2, we have Osisko Gold Royalties with a ticker of OR. They hold more than 175 royalties on gold and precious metal mining, including a big 5% stake in Canada's largest gold mine. Their current price comes in at $19.96. They've got a nice looking market cap of $3.70 billion. They have a pretty stable beta coming in at 0.65. Their earnings per share, a little on the low side, 0.22. Their price to earnings ratio, that comes in at 90.73. This is a company that is growing, so that may explain that PE ratio. Their return on equity, a little bit on the low side, 2.38%. Their debt to equity ratio, that looks great. It's 18.63%, so they don't have a ton of debt. Their yield is a little smaller at 1.202%. It's a quarterly dividend of 6 cents per share. The payout ratio, surprisingly, is a little high at 104.55%. And I think part of that is because their earnings per share is a little bit on the low side. So there's definitely a few little areas that I would be slightly concerned about with this company. Now, let's take a look at their return on investment. The 3-year return on investment comes in at 34.50%. Factor in the dividends, we get 39.92% as their total return. This year, 2023, their year-to-date comes in at 19.5%. Factor in the dividends, we get a total return of 20.50%. That's very good. It's more than 3 times the TSX's 5.51%. Gold is doing well, and that is good for their royalties. In fact, their earnings are forecast to increase by 15.86 over the next year, which will improve these fundamentals a good amount for sure. In our top spot at number 1, we have Prairie Sky Royalty Limited with a ticker of PSK. They own a bunch of subsurface mineral rights on a variety of royalty properties in Western Canada. Basically, they let other companies come in and drill on those properties, and then they collect a bunch of royalties from them. That's not too shabby. Their current price comes in at $25.13. They have a nice looking market cap of $6.01 billion. Their beta, pretty volatile at 1.74. Their earnings per share comes in at 0.95, and they've got a price to earnings ratio of 26.45. Their return on equity, that comes in at 8.25%. And their debt to equity ratio, another nice looking one, 8.58%. I mean, the reality is with royalty companies, you're almost always going to get nice looking debt to equity ratios because they don't have a lot of overhead. When we look at their dividend, their yield comes in at 3.82%. It's a quarterly dividend paid out in the amount of 24 cents per share. Their payout ratio, a little bit on the high side, 101.05%. When we look at their returns, their 3-year return on investment, that comes in at 132.90%. Adding in those dividends, we get 152.09%. This year in 2023, their year-to-date comes in at 16.29%. Factoring in the dividends, we do get a total return of 20.73%. And once again, not a bad number, more than 3 times the TSX. You can't fault them for that, that's for sure. This is a business model that is absolutely just simply hard to fail with. And as long as they have that oil and companies that want to drill it, they have a constant supply of cash coming in. We have a bonus stock for you today. It is not a royalty stock, but a trust that has a few similarities to royalty stocks. It is the Sprott Physical Uranium Trust with a ticker of U.UN. I included it as it operates somewhat like a royalty, except in this case, it holds a physical asset in addition to investing in it, and that asset, of course, is, well, uranium. Their current price comes in at $26.37. They got a nice looking market cap of $6.55 billion. A super stable beta of 0.35. Their earnings per share come in at 1.16, and they have a price to earnings ratio of 22.73. Now, because it's a trust, we don't have a lot of extra data. So we do not have a return on equity, and we don't even have a debt to equity ratio. They have no dividend, so wow. But let's take a look at the returns and see what we're getting here. So for their 3-year return on investment, it comes in at 191.06%. That's pretty good. Let's take a look at the year-to-date 2023. We have a return of investment of 65.54%. Holy banana bread, that's really good. This has more than 10x the TSX. Uranium is a no-brainer as the demand for clean nuclear energy is at an all-time high. As usual, if you are interested in any of these stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Keep the learning going. Watch my video on the 0 to 100K TFSA challenge linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.